Hi everyone, welcome again to another financial analysis video with myself, Moeed Amin, and Ted Wayman. So today we're going to be looking at Range Resources Corporation. Before we dive in, don't forget to like, share, subscribe. If you are a subscriber, or actually if you're a viewer, if there is a company that you're interested in, whether it's for selling purposes, you're selling to that company and you want to know a bit about the finances, or if you're thinking about investing in the company, or even if you're joining the company as an employee and you want to sound impressive on the interview, do leave a note in the comment section and make your request for the company you would like us to analyze. 98% of the companies we analyze here are requests from you, the viewers. If you're a subscriber, you will get instant notification of when we publish your analysis. So let's get to it. Range Resource Corporation. Now, this is an interesting business because this company is essentially natural gas or natural gas liquids. And they're actually one of the biggest players in the US. And they're a pure play business, which basically means that, and they're one of the few actually in America, and basically that means that they're dedicated to natural gas resource rather than other companies that may have a portfolio that includes crude oil, for example. Now, they primarily have assets and land or reserves in Pennsylvania, and they have about 460,000 acres of land or of space that they're using to extract the natural gas. Now, the stock price has been rising, which is bucking the trend generally because, as we all know right now, stocks are pretty much in decline across the board. But they're bucking that trend, which is interesting, which I guess is why we got this request. And just before we show who made the request, one thing to also note is that from analysis, this company has about 15 years worth of reserves. Now, that is important, obviously, for a resource company because the reserves and the amount of reserves that they have basically gives you an idea of its run rate as a business and therefore how long they will hold their value as an investor if you are an investor in this company. So worth knowing about that. So the request came in from one of our viewers, Vipul Sharma. This is your video. Hope you find it useful. Do leave a note for us once you've watched this so you can let us know. Quick note on the share price before we go into the financials, and we're actually going to talk about the share price and the context for that later on. So stick around for that. That's going to be very important once we analyze the fundamental financials here. But they floated in 2018. If you invested then, you would be sitting on an increase of around 67%, not bad. And if you'd invested last year, you'd be sitting on an increase of 59%. So there seems to have been a bit of an upward trajectory and then a bit of a decline. So could now be a good time to buy such a company. We'll find out later on, or at least we'll see what the fundamental financials give some sort of clue about that. So let's get to it. Ted, let's share with our viewers the finances for this company. Some interesting things actually when we looked at it.
Yeah, good to see you, Moeed. Thank you very much indeed. So, and welcome to all of our viewers. Here we go. So let's go and have a look at Range Resources annual report and account. Here it is. It's for 2021. It's on their website. Now there are some updated figures, a quarterly, but we're just going to look at the audited figures, and obviously you can apply this analysis to their latest forecasts and projections. We're going to whiz through this 10K all the way down to the actual financial statements, which you will find a little bit further down, and we're going to start with the income statement. So here is the income statement, and we are looking at 2021. So there is 2021, the left-hand column, and we are dealing in dollars. We're dealing in dollars in thousands. So when we look at the total revenue, here it is 2.9 million thousand, which is so just shy of $3 billion. So that kind of gives us an idea of how big this company is. $3 billion in turnover. You'll notice here, quite interesting, that there's this derivative fair value adjustment. So what these guys are doing is that they are using derivatives in order to manage their exposure to the price of gas. So in effect, what they're doing is they're extracting it, and they're saying, look, we kind of just want to know what we're going to sell it for, and therefore we are kind of buying the right to sell it at a future price at some point in the future. And sometimes they're going to make a loss on that, and sometimes they're going to make a profit on that. So that kind of but that's what they're trying to do, is just to take risk out of it. They don't want gas to go to kind of $0 and then suddenly find that they're trying to extract it and they can't sell it at a profit. Increase in the revenue, pretty substantial increase in revenue, 49%, although you'll notice that there was a corresponding decrease in value 2019 to 20. So again, you're probably looking there at the pandemic, oil prices falling, and that's going to sort of taken its hit there, and then they'll come back again. So that's not necessarily a 49% increase in production. A lot of that will be a 49% increase in the price of natural gas, and these guys will be what's known as a price taker, i.e. the market will set the price of gas and then they will sell it at that market price, hence the use of derivatives to manage their exposure. No real cost of sales here, so it's a kind of a fixed cost business. It's a production business. Biggest cost there is a kind of transportation, gathering, processing, and compression. So liquid natural gas, you kind of need to take that gas and compress it down. That costs a lot of money. Few other things to notice here. We've got the interest. So typically, in our traditional kind of structure of a P&L account, we'd be taking our interest out. The tax is down the bottom down here. We'll look at that in a minute. They're actually getting some tax rebates, which is quite nice. There's the depletion, amortization, and depreciation amortization charge. And a couple of other things. So things like these exit and termination costs. So, when they have finished their exploration, they need to kind of make good. For example, there's some exploration costs coming in there. There's abandonment. It's not a big number, but they're kind of they're out there, they're looking, and they're exploring, and some of that exploration they're just going, what, we couldn't find any, we need to kind of close up and move on, and that's the cost of doing that. So some interesting numbers. You look at that abandonment, for example, back in 2019, that was a significant number. They spent $1 billion basically just just binning stuff and just saying, this isn't going to happen, we're gonna pull out. Anyway, the summary is that looking at these three numbers, they've kind of got some quite big impairments and quite big abandonment, big loss back in 2019, a loss in 2020, and now they are making a profit. Now, I'm sure that those numbers are structured into telling a story, and what they want the market to realize, or the market to read into this, is that we have now turned around from being loss making, we're now profit making, climb on board, and the share price should start going north. It's never quite that easy in the exploration, because if they kind of hit a few more dud wells, then they are back to loss making. So this is not a massive profit margin, 400 million on a 3 billion turnover. You're looking at about 14%, so not a lot of room for error. A little bit of sort of tax rebates, these kind of deferred tax rebates coming through. You'll notice here, and there's their bottom line, about $412 million bottom line profit. So there's the profit and loss account. Not a lot else I can kind of add to that, I guess. Income per share has gone from negative to positive, as we'd expect. In terms of the balance sheet, quite interesting, the balance sheet. So just these bits down here, this is the non-current assets. So these are the things that we need to run the business. Interesting that they actually show the depreciation. So this is the accumulated depreciation charge on the balance sheet. So they're saying, look, all the stuff that we bought cost us 10 billion, and to date we have depreciated it by 4.4 billion, so it's worth about 5.8 billion. That's the kind of the story they're telling us there. And these are the natural gas and oil properties and successful efforts of methods. So there's a particular method of accounting for the property, plant and equipment they've got, which is sitting over proven reserves, from which they are effectively extracting right now. And then up at the top, we've got the current assets, and the current assets up here. They've got the cash, so reasonable amount of cash. Quite interesting, big increase in cash going on during the year. Might have a look at the cash flow to find out what's going on there. Accounts receivable has also increased, you know, that's really driving this increase in the total current assets. You remember, current assets, things that we own, which we are trying to turn into cash or already are cash. Down the bottom, we've got our liabilities. Now, interesting, the current liabilities. So here we've got a ratio, the current ratio comparing the current assets to the current liabilities. This looks to me like it's an alarm bell. This doesn't look at all healthy. Now, I'm not overly familiar with oil and gas and liquid natural, so you know, I don't know whether there's something in their business model that allows them to operate at that kind of negative liquidity ratio. I know that there are industry sectors which are quite comfortable at operating at a liquidity ratio of below 1. I don't know whether these guys are in there. There's nothing obvious that I can think of that would lend itself to that. They've got things like these accrued liabilities, and these accrued liabilities, these will effectively, I would guess, be decommissioning costs. So in effect, if you're drilling, you need to be putting some money aside metaphorically in order to pay for the decommissioning that you are going to be incurring on those exploration wells, effectively, for want of a better word. A little bit of short-term debt in there. Some derivative liabilities. Again, these derivatives, they're stuck all over the place, and you'll see some derivative assets up there. And again, they're just using derivatives to manage their exposure to adverse, you know, exchange rate movements, perhaps, but probably more likely commodity prices, i.e., liquid gas prices. So yeah, you know, not 100% convinced by that liquidity ratio. And you know, once again, I'm always willing, if we have a viewer who's more knowledgeable about this particular sector and would like to set me straight, I'm more than happy to take their comments. Please be polite in the comment section. Quite a lot of debt. Just a lot of debt, you know, and I get these guys, you know, they are in the exploration and the extraction. Typically, you're going to fund exploration through equity and debt for the extraction, but they do have a lot of debt, and that is just, you know, potentially, you know, makes me a little bit nervous. There's something like, you know, 60% funded through debt, 40% funded through equity, and that looks to me like it is quite high. And that's really taking up most of their non-current liabilities. You know, they have some other stuff as well in there, but really the substantial amount is that debt. And that brings us down to their shareholders' funds, and you'll notice on their shareholders' funds that these guys are really, they're funded through investment by the shareholders, and they've been making losses. Now those losses have come down because they've made a profit in the year, and the question is, have they turned this metaphorical corner? Is it now, you know, profits all the way through, or are those profits going to bounce around, and sometimes they're going to be making a loss, sometimes they're going to be making a profit? I don't know what the answer is to that. The cash flow statement. We'll look at the movement in equity. Nothing really very exciting going on in the movement of equity. We can see there's the loss from the previous year. There's the profit from this year. They're not paying out any dividends. You wouldn't expect them to. They're not doing any share buyback. So nothing really interesting going on in the movement in equity. So in terms of their cash flow is quite interesting. You'll notice that they are generating cash. Okay, so these numbers here suggest they're very cash positive. Even when they're making a loss, they're generating lots and lots of cash. And what you're seeing here is you know, things like, you know, this depreciation, abandonment of unimproved properties. You know, these are costs to them, but because they've already been accounted for, they're not actually costing anymore in terms of the cash. So quite interesting looking at this number here. This is the net cash flow from their operating activities. Just to remind us, this is the cash equivalent of their operating profit, effectively. And there's a little bit of kind of this movement in the derivatives, and there's kind of cash settlement on derivative financial instruments, offsetting a cash loss. So effectively, they're paying off that derivative loss, or effectively they're covering their derivative loss. So really, this profit is effectively your profit add back depreciation, and you end up with the operating profit. And I think that this is so these guys are generating cash, and that's definitely a good thing. They are investing, so they are they are adding to their fields, whether that's by buying companies or exploring into new areas. It's not absolutely 100% certain, but they are adding. A little bit of divestment going on, disposal of assets. You'll notice a couple of years ago, that's fine, once in a while. And then in terms of financing, we can see here borrowings and repayment of borrowings. They're paying down their debt. In fact, they're not. They're pretty much. I'm sorry. We need to take these three numbers together. In fact, probably need to take these four numbers together. So take these four numbers together, and what you see is that they are pretty much kind of even keel, and they're just refinancing their debt. So they're not trying to pay down that debt. They're just refinancing. Little bit of debt issuance costs, tax paid, no dividends, no share buyback. So really the sum total, having had not a lot of cash sitting in the bank, they've ended up with actually a pretty reasonable cash pile, $214 million, which I guess makes me a lot more comfortable than a company like this, $3 billion turnover, potentially making a loss with $458,000 in the bank. Really, there's not a lot of wiggle room there. So they have been preserving cash, which is certainly a good thing. And it looks to me like they can afford their debt as well. So just go back to the this interest that they're paying. If we were to kind of structure this in a traditional way, they're making an operating profit of 629 before interest and tax, and they're paying 227 of interest, 3 times covered, which gives me sort of reasonable confidence. So I think the answer is that these are numbers which I mean, they're interesting. I'm struggling to know whether they're really, it looks like there's a theme, but I'm struggling to know whether there really is a theme. It's cash generating, it's turning the corner. It's got a liquidity ratio shot to pieces, but maybe that's okay for the industry. But I don't know. There's something that just doesn't quite hang true for me, and I'm not 100% convinced. Let's go and have a look at the share price, as you mentioned, Moeed. So here is the share price. It's up, it's bouncing around a little bit, kind of timing the market. Quite interesting looking at some of the metrics in the red box here. We've got a market cap of 7.2 billion. So just to remind us that the balance sheet is about 2 billion. So you're looking at just over 5 billion of kind of goodwill stuffed in there. So there's if there is a lot of good news, a lot of that is reflected in the actual market. I'm also interested that they don't have a PE ratio. That may be, and as I said, we haven't looked at the quarterly earnings. It may be that they're now in a quarterly loss, which is why the P ratio has gone to 0. But they were 17 times earnings, and 17 and a half times earnings based on 2001 is not overly cheap. And there's no dividend yield because they're not. Right? So 2021, yes, sorry. So based on the 2021 numbers, if we plug in our earnings of $412 million, then they would be trading on a 17 and a half times earnings ratio, which is not. It's not crazy expensive like the markets have been recently, but it's not crazy cheap either. It's not a screaming buy all over this. No dividend yield because they're not paying out dividends. Are they going to pay out dividends? Well, again, that kind of depends on whether you buy into their story. So I think the kind of the conclusion here, Moeed, is that these guys are. They are, they're there, they're doing what they do. Is this a commodity play? Quite possibly. I'm not sure that they're kind of, they're really delivering what they have been promising. And the question is, have they turned the corner? Have they are they now going to start delivering jam? This looks like to me it's been a jam tomorrow stock for a while. And, they've been burning cash. But then maybe, world of inflation, we're looking at, gas prices rising, all the problems going on in the Ukraine, for example. Maybe these guys are a good play. Maybe these are a good energy, an energy play, and maybe that's the rise that we've seen over the last few months. You can see since 2022, but I'm not sure this is really for the faint-hearted. I'm not sure you're going to do a multi-bagger on this either, but then I may be wrong on that as well. So who knows? Moeed. So there you go. That's my kind of viewpoint. No opinions there. Staying very much firmly on the fence, I think, on this one, Moeed.
Yeah. And what will be interesting to see is, one other element that I neglected to mention at the beginning, which is, the analysis shows that demand for natural gas will outpace supply. So that may have an impact in terms of the price of gas going up, which may, as long as they are not hitting too many dud wells, that should prove positive in their P&L, as well as their probably balance sheet. More P&L. So interesting to see how that will go. So we'd love to hear anyone else's thoughts, particularly those, as Ted said, who are involved in this industry and know this industry very well. What are your thoughts here? Could this be a company that one of the larger players may want to acquire, which might mean a premium on your investment? So yeah, do leave a note in the comments section. Like, share, subscribe. Especially if you subscribe, you will get notification of our next videos, especially those that you have requested. So until the next analysis, thank you, Ted. Thank you, everyone.
Good to see you, Moeed. Catch you later. So I hope you enjoyed that video and found it useful and informative. Now, if you want to know more about what I do, then you can visit Talk Financials and find out about the training workshops and the clients that I work with. And the QR code is on your screen right now. If you are interested in being able to do this yourself, to do some financial analysis, there's a couple of resources. There is an online workshop. It's available on my website, or you can click on the QR code and it'll take you straight through to this online workshop where you can learn to read and understand and interpret financial information yourself. Alternatively, there is a book available at all good bookstops, particularly a very big online one, and the QR code once again will take you through to the opportunity to buy the book, and there is also a Kindle edition. Otherwise, that's everything from me. Please don't forget to like, share and subscribe to the channel. More subscribers means that you're going to get notification about new videos coming up, and also the opportunity to ask questions, and do recommend any videos any companies that you'd like me to analyze for you. I think we've got a couple of suggested next videos coming up, so please do take the opportunity, have a look at the other videos, and don't forget to like, share and subscribe to the channel, and I will see you on the next video.